All right, let's do a market update. Let's see what's going on. Let's dive into the numbers and see what's going on in Canada's housing market right now, August 2024. A recent report from RBC indicates that Canadian real estate markets are not stabilizing following recent interest rate cuts. Now, instead, demand is softening across major regions, particularly as investors exit the market. Now, despite the Bank of Canada's implementing rate cuts back in June and July, early data shows a continued decline in home sales. And we're also seeing a notable increase in inventory levels, meaning houses are sitting on the market for longer, still waiting to be sold. This trend is particularly pronounced in key markets such as Toronto, where investors are seeking to reduce their exposure. Now, as we look into the numbers, we will highlight that the anticipated psychological boost from lower rates has not yet materialized. Home resales have decreased in several markets, including Vancouver, Calgary, and Toronto. We saw a small uptick between May and June, and then home resales fell again in July, and we're seeing it happen right now with properties sitting on the market with the lack of showings, with the lack of buyer interest. So this would suggest that we would need something to incentivize buyers to get back in the market, which is most likely interest rate cuts. Further interest rate cuts are needed in order to get buyers back in the market. Now, while a few major markets reported July data, the results indicate a sluggish environment. Higher-end markets are experiencing slower sales and increasing inventory. Toronto has slipped into an oversupplied market, meaning there are lots more houses available for sale and they are not moving. Again, suggesting that lower prices or lower interest rates may be needed to incentivize inventory movement. Now, across the board, most markets have seen a relaxation of conditions compared to last year, with new listings outpacing sales. We can see that the surge in inventory is attributed to two main factors. One, investors withdrawing from the market, and sellers who initially believed that rate cuts would improve market conditions. Like in Toronto, for example, the influx of inventory is partially due to the completion of new condo units, all coming on the market right now, which investors are eager to either assign prior to closing or sell as they get closed. Meanwhile, some sellers are banking on lower interest rates to reignite buyer interest, and others may be facing financial distress as a result of high rates or upon mortgage renewals being hit with these high rates. So looking ahead, looking ahead, I believe that we're going to see more market stagnation in the coming months, reiterating that we need substantial rate cuts in order to generate a meaningful impact on demand. We're also at the tail end of summer, where a lot of people haven't got back in the market. And typically, the fall market starts in September, where a lot of people get back in the market who want to purchase, who want to move prior to snowfall or Christmas. So, with this information, who you work with matters.